Good morning, everybody. It's me, Herb Morgan, Senior Managing Director, Chief Investment Officer here at Cantor Fitzgerald Managed ETF Portfolios. This is my weekly economic market commentary for the week beginning today, Monday, July 22nd, 2024. As a reminder, I can be found intra-week if there are developments worth commenting on LinkedIn and or X. LinkedIn is Herb Morgan. X is at ETF_strategist. The presentation you're seeing and or hearing has been prepared by us for use with you, whether you are an investor or a financial advisor. Either way, you're expected to make your own investment decisions. Nothing contained in this presentation should be treated as investment advice, no tax advice, no recommendations for the purchase or sale of any security. Everything is purely for informational purposes. Well, we had a mostly down week, but this rotation we've been talking about for a couple of weeks, where investors are selling some of the winners, big cap, mega cap technology names, the Mag 7, S&P 500, NASDAQ 100 type names. You can see that S&P 500 down almost 2%, but small cap stocks up a little more than 2%. I had highlighted for you a few weeks ago the valuation difference. And now people thinking perhaps this rally is broadening out. Nothing wrong with the big cap names. In fact, earnings season is underway and big cap earnings are just a couple of weeks away, and I expect they will be fantastic. But a relative value differential existed. Markets noticed that, and you've seen a little bit of capital flow out of the bigger names and into the smaller names. Whether or not that's a longer term trend is yet to be seen. International markets sold off, as you can see. Bond markets sold off a little bit. The 20-year Treasury index down about 1%. The aggregate bond index down about a third of 1%. We got plenty of economic data last week, and some of it, quite frankly, was kind of mixed. Let's start with the New York State or Empire State Manufacturing Survey. It fell from -6 to -6.6. The line of delineation between expansion and contraction for manufacturing in the New York region is 0. So they say that in July, manufacturing slowed down, cooled, contracted, however you want to phrase it. It wasn't a great number. New orders were negative as well. Shipments improved a little and were positive. Employment was up, but still in contraction, meaning the number was higher, but there was still fewer people employed in manufacturing, and expectations continued to decline. So you start out the week and you see that report and you say, wow, this is a small regional manufacturing survey. Of course, we're going to get the national surveys later. So you're not optimistic until a couple of days later, you get the Philadelphia regional survey, which is very close to New York geographically. And it was completely the opposite. And this just happens sometimes. Philly Fed survey rose from 1.3 to 13.9. That 13.9 was higher than all estimates in the survey, higher than the highest estimate in the survey, obviously. The consensus was 2.9. New orders went from declining month over month to spiking. I mean, it straight up spiked to almost 21. Shipments went from declining to a straight up spike of 28. Employment, same thing. And the outlook there jumped considerably. So you have two surveys, very close regions, just telling us two different things. It's one of the reasons why we don't overreact to any one particular piece of economic data. We have to take them all into consideration and try to look for larger macro trends. As for these, they directly conflict each other. I can't explain it other than I will be looking at the two national manufacturing surveys that we'll get here soon. We'll get them. It's either end of this week or next week. We'll get those. Those will be the flash readings, and then the final readings we'll get in the first week of August. We then got retail sales. They were unchanged. The estimate was that they would decline 0.3%. And May was revised from up 1/10 to up 0.3. The little bit of drop we saw at auto dealers, there was a cyber attack. Who knew? Sales backing out, autos and gasoline up 0.8%, widely seen as a positive or a good report. Then we got this report on business inventories for the month of May. They are up 0.5%, 0.5% after a gain in April. When you see inventories rising, you ask yourself a question. Are inventories rising because CEOs are more confident about the sell through that's coming? Or are they arising because the sell through is not happening? And so to find out, we look to the inventory to sales ratio. And if the inventory to sales ratio is going up, that's seen as a negative. The economy is slowing. If it's going down or remaining steady, it's seen as positive. And it was steady. As a matter of fact, it's been four straight months of exactly a 1.37 inventory to sales ratio. Where news isn't so good is the housing industry. The housing industry is the most negatively impacted when interest rates are high, and it's the most positively impacted when interest rates are being cut. So the National Association of Home Builders surveys its members, puts out a sentiment reading, and in the month of July, it fell again, fourth consecutive monthly decline. The lowest level of 2024, it came in a reading of 42. Current sales reading fell. The current traffic reading fell. The only thing was expectations did rise for the future. That is likely attributed to the fact that the futures markets, are predicting a cut in interest rates at the September Fed meeting. Remember, I still think it's November. I don't think the economic data is deteriorated enough to justify a cut in September. And I certainly don't think the Fed wants to appear to be trying to influence or impact elections in any way. They want to maintain the credibility of their independence. And I think they will wait until after November 5th, raise and cut rates on their November 7th meeting. We got June housing starts. They were up 3%. That was a little better than expected, but they had fallen significantly in May. The number here, you can see we're running around 1.3 to 1.4 million. We were, much higher back when interest rates were essentially very low. Really not a whole lot to see here. Residential real estate prices are driving, rents, owners equivalent rents, different things, and that's a big challenge for people trying to get into those markets. June industrial production up 0.6%. That was double the estimate after a 0.9% gain in May. Capacity utilization continued to rise too. So we had this sort of slowdown, very, very moderate from a high pace. This capacity utilization number above 80, I always say, is really inflationary. Below 80 is sort of signals sort of a price stability. Way down here, you say is deflationary, disinflationary, recessionary, even. But another positive. So really, all we got so far, if you start looking at the data from last week collectively, the only negative was that small reading from the New York State or Empire State Manufacturing Survey, and everything else seems to be continuing to point towards a fairly healthy economic situation. We get jobless claims every week on Thursday morning. And that number bumped up a little bit. And you can see here, this is not much of a bump, right? 200 is super low. 240, 250 is still very low. It's still very good and healthy. We had a bump last summer that reversed itself going into September. If this is a pattern that matches, we get to 250, 260, and then we start to roll back down. What is different this year from last year, though, is that continuing claims for unemployment. And I posted this on LinkedIn last week where I said, hey, don't look now, but continuing claims are starting to get a little elevated. This is not, recessionary by any means. It's just notable that continuing claims for unemployment, which have been ticking around, 1.7, 1.8, are now at almost 1.9 million. Depends on the scale you make here, right? Before you get overly panicked. I made the scale to represent the numbers I was showing. So it's pretty tight, right? 1.7 million at the bottom of the scale, 1.9 million at the top of the scale. But we've also had a stagnant number of total Americans employed now for a couple of months, even though the jobs reports show some gains. Worth watching, keeping an eye on. I'm sure the Fed wants to cut rates. if this number went higher in the next few weeks or months, that could, increase the likelihood of that September rate cut. The other thing that happened last week that was important was earnings season kicked off for the calendar quarter that ended in June. We have had 73 out of 500 companies report so far. That's really not enough to make any kind of conclusion about the earnings season. Usually the financial companies report first, then it's followed up by industrials and consumer and the big cap tech, et cetera. And 29 of those 73 names were financials. Average sales surprise was a beat by about 0.4%, versus the consensus estimate. The average earnings surprise was a little over 5% beat. This week, we've got 131 names, 131 out of 500. So a lot, about 25% of the S&P 500 names report this week, including some, what I would say, headline, consequential, big names, large contributors: Juniper Networks, 3M, Bristol Myers, Coca-Cola, General Electric, Tesla, and Google, and Juniper in that tech space. And of course, the other big thing that happened over the weekend is that President Joe Biden dropped out of the presidential race. And of course, the number one thing that I get when I get your calls and your emails, which I appreciate and I encourage, is what's going to happen if? What's going to happen if? And I generally don't like to make investment decisions sort of betting on what might happen in the political or geopolitical sphere, but taking a look at the predicted market, the odds of Kamala Harris, the current vice president, becoming the Democratic nominee. Those odds started to go up very considerably at the beginning of the month after the poor debate performance calmed a little bit and then started spiking up last week. And then as of this morning, it looks like she's about 85% likely to be the nominee of her party. So far, she has declared and nobody else has. And then, of course, we look at the likelihood, according to the predictive betting market, of either Donald Trump or Kamala Harris becoming the presidential election winner. And you can see here, Trump peaked at about 69% likelihood right after the assassination attempt, maintained pretty sizable numbers during the Republican National Convention last week. And then after President Biden dropped out and Kamala Harris got in, she now went up to about 39% versus 60%. Of course, they still have their convention in the process. She's not officially or formally the nominee. It just looks more likely. Some differences. There are definitely differences. One of the biggest differences between Joe Biden and Kamala Harris relates to their opinion on their preferred tax on corporate profits. If you recall, the Tax Cut and Jobs Act of 2017 lowered the corporate profit tax very substantially. President Biden had favored raising it back up to 28%. Vice President Harris favors raising it up even higher to 35% corporate profit tax. Okay, in terms of this week, it's earnings, as I mentioned, but there is also some economic data. We'll start with existing home sales tomorrow on Tuesday. The flash readings that I mentioned earlier, I couldn't remember if they were this week or next week. There they are. S&P Global's manufacturing flash reading for July is Wednesday, as is the services reading, new home sales, jobless claims. Second quarter GDP is expected to be revised higher. The initial report was 1.4, go up to 1.9. So all those who say the economy is slowing, if you get an upward revision to GDP, that's a difficult argument to make. Friday, personal income spending, PCE price index, that is the most important indicator of inflation and the fight of inflation that the Fed is going through right now, and then consumer sentiment. I hope you're enjoying this. I'll be back again in 1 week. Don't forget, we're available on YouTube. The channel is called Slaying Bulls and Bears. Our tagline is "We make the complex and complicated simple and sensible." Also available as an audio podcast on pretty much anywhere you'd like to listen. Thanks. Be back to you again next week.